Bernie Madoff, the $65 billion fraud, December 2008. Wall Street was already bleeding, banks collapsing, markets freezing, liquidity evaporating, and inside a quiet office, a man finally admitted the truth. There were no investments, no strategy, no portfolio. For nearly 20 years, the wealth was fictional. $65 billion, printed on paper, repeated on statements, believed without verification. This is not just a fraud story. This is a slow-burn institutional failure, where reputation replaced evidence and comfort replaced scrutiny. This is the forensic autopsy of Bernie Madoff. Section 1. The illusion of control. He did not promise miracles, promised calm. While markets convulsed, his numbers barely moved. Month after month, the statements arrived. Green ink, steady percentages, no volatility. Real markets leave scars. His reports did not. And instead of asking why volatility had disappeared, investors leaned closer. Because stability is seductive. Section 2. A closed system. Pull back the curtain. Who executed the trades? Internal desks. Who held custody of assets? Internal control. Who generated statements? Internal systems. Who audited the operation? A tiny, obscure accounting firm few had ever heard of. Layers of independence, removed. Layers of verification, dissolved. The structure was not just opaque. It was engineered to prevent intrusion. Section 3. Follow the money. In a legitimate fund, assets move through clearing firms and custodians. Records exist across institutions, but here, cash flowed inward, and rarely outward. New deposits funded redemption requests. No large securities transactions. No corresponding market footprint. No defensive hedges. Just circulation. Money entering. Money exiting. Nothing compounding in between. It looked like investment performance. It was cash recycling. Section 4. The warning. No one heard. Harry Markopoulos ran the numbers. He didn't speculate. He calculated. The volume of options required to execute Madoff's claimed strategy exceeded what the market itself could provide. It was mathematically impossible. He submitted detailed reports to regulators, line by line, equation by equation. The response? Limited examinations, surface-level audits, assumptions of legitimacy. No one wanted to believe the alternative, because the alternative implied systemic blindness. Section 5. The psychology of silence. Fraud at this scale survives on human bias. Exclusivity created desire. Access required invitation. Scarcity manufactured prestige. Then came consistency. Steady gains reduce anxiety. Reduced anxiety lowers vigilance. Over time, comfort replaced curiosity. Then social proof took hold. If respected institutions were invested, individual investors felt absolved of responsibility. Due diligence was outsourced to the crowd. And finally, authority bias. Former NASDAQ chairman, industry pioneer, established insider. Status muted skepticism. No one wanted to accuse a man at the top of the financial hierarchy, so doubt stayed internal, and silence became complicity. Section 6. The breakpoint. Every illusion eventually encounters stress. In 2008, liquidity disappeared. Investors demanded cash. Billions in redemptions arrived simultaneously. There were no assets to liquidate, no hedges to unwind, no positions to close, only a bank account reliant on new deposits. When new deposits stopped, the equation inverted. The scheme did not unwind slowly. It froze. Within days, decades of fabricated performance evaporated. Section 7. The damage. The estimated reported losses reached $65 billion, including fictitious gains. Actual principal losses were lower, but devastating. Charities collapsed. University endowments fractured. Families lost generational wealth. But the deeper fracture was trust. If oversight could miss this for nearly 2 decades, what else was hidden? The scandal did not just bankrupt investors, it destabilized confidence. Section 8. What this really was. This was not financial genius. This was narrative control. Madoff understood something fundamental. People prefer steady lies over volatile truth. He did not manipulate markets. He manipulated perception. And perception, left unchecked, compounds faster than capital, until reality intervenes. Final frame. For nearly 20 years, statements arrived on schedule. Balances grew. Confidence expanded. No one demanded to see the machinery behind the curtain, until liquidity stress tore it open. $65 billion. Not lost in a crash. Not erased by bad bets. Manufactured. And when the system finally required evidence instead of reputation, there was nothing underneath. This is the case study lab, where we dissect collapse, not as spectacle, but as structural failure. End.